This week on Wealth Track, how to become an intelligent investor. Jason Zweig, editor of the new edition of Benjamin Graham's classic, The Intelligent Investor, reviews its timeless principles with us. He is next on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. 2024 marks the 75th anniversary of the publication of The Intelligent Investor, the Benjamin Graham classic known as the definitive book on value investing. Warren Buffett calls it by far the best book on investing ever written. Well, if you have never read The Intelligent Investor, you are in luck. A new edition was just published, its first updated version since 2003. It is a feat accomplished by Jason Zweig, the same journalist who took on the monumental 600-plus page task 20 years ago. As in the previous version, Zweig has left Graham's text virtually unchanged. What is added is Zweig's chapter-by-chapter commentary and updated footnotes that put the legendary investor's time-tested investment principles in current market perspective. Jason Zweig, who was one of Wealth Track's early guests, is an award-winning financial journalist who has written the must-read and aptly titled The Intelligent Investor column at the Wall Street Journal since 2008, having started the column at Money Magazine in 2003. Zweig is also the author of several books of his own, including Your Money and Your Brain, one of the first books to explore the neuroscience of investing, and The Devil's Financial Dictionary, a satirical glossary of Wall Street. I asked Zweig why The Intelligent Investor, a book written in 1949, still has relevance for investors today.
Well, of course, you could also ask why the Bible, issued some 2,000 years ago, is still relevant. And this book is the Bible of investing. I would argue it's more relevant today than when it was first published in 1949, or when the last edition was published in 2003, or when Graham's last revised edition during his lifetime was published in 1972. The reason it's so much more relevant is it's never been easier to invest, and it's never been harder to invest intelligently. There's so much propaganda, so much pressure on people to trade as fast as possible, to chase momentum, to listen to what other people are telling them to do, to follow the crowd. And to be an intelligent investor means to be independent. And that is very difficult in a world full of smartphones and social media. And so the book is full of advice on how people can listen to their own counsel instead of sort of acting on the worst advice that's out there.
So back to basics. Why do you say that this is the Bible of investing?
Graham understood from his own experience and from, his extremely long career on Wall Street that investing isn't about mastering the markets. It's about mastering yourself. It's not about trying to control whether the stock market goes up and down, or to control whether you pick exactly the right security at exactly the right time. It's about controlling yourself. You are your own worst enemy when you invest. And the key is to put policies and procedures in place that will protect you from hurting yourself. And that's really the heart of the message of the book.
As far as controlling yourself, to be a good investor, you still need to know what you're doing. And certainly Security Analysis, which was the book that Benjamin Graham co-authored with David Dodd, published in 1934, is considered to be, the Bible of professional stock analysis. But to be an intelligent investor, don't you need those skills as well? So where do those fit in as opposed to just controlling yourself?
In the very first edition of The Intelligent Investor, Graham gave a lengthier definition of what he meant by intelligent in the title. What's an intelligent investor? And, your first thought would be it's somebody who's really smart, maybe someone with expert training, like a financial analyst, a chartered financial analyst. Maybe you're a CPA, maybe you have an MBA, maybe you have a PhD in finance. And Graham wants us to realize it's not about those acronyms, and it's not even about your IQ. He was very specific. He said, the kind of intelligence I'm talking about is more a matter of your character than your brain. And what he meant was that you had to have a set of common sense, practical skills that go into good judgment and decision making. Things like skepticism, independence, open-mindedness. And those principles are what you really need.
Now, of course, Ben Graham himself was an extremely successful investor. What kind of experiences did he have that led him to this definition of what it takes to be an intelligent investor?
Ben Graham arrived on Wall Street in 1914, if you can believe that. And he experienced his first stock market bubble in 1919 when there were a bunch of, let's just use the correct term, crappy IPOs, most of which went bust, and one of which I believe he bought to his regret. And then, of course, he experienced the boom of the late 1920s and the crash of 1929 and was almost wiped out. It was in 1934, when he was writing Security Analysis, that he started summing up the lessons that he had learned over those periods. Graham went on from 1936 to 1956 to manage the Graham-Newman Fund, which was one of the most successful mutual funds in history. And he essentially outperformed the S&P 500 by about 5 percentage points a year for 2 decades, which is one of the best track records anyone has ever produced. So he was an enormously skilled investor. And then in 1956, he just walked away. He decided he'd been doing it long enough, and he wasn't interested in piling up more millions. He wanted to basically sit and think. And he continued to teach, but he no longer invested actively. And he became a great observer of the markets after that, even though he was no longer a professional participant.
He was at Columbia, and that's where Warren Buffett was a student of his, right? And of course, the rest is history as far as Warren Buffett is concerned. You mentioned the characteristics of an intelligent investor, and there are very important principles that are laid out in The Intelligent Investor in the book. So tell us about what the major investment principles are.
So there's 3 or 4, Consuelo, and they're very basic. Some of them sound almost too obvious to be true, but they are. They've been valid ever since Graham first formulated them. So the first is the difference between investing and speculating. So many people today call themselves investors when in fact they're just speculating. They're buying a stock because they like the ticker symbol, because somebody down the road is buying it, because somebody they met at the gym said they made a lot of money on it. They do no research whatsoever. They just throw some money at it. And Graham's point was, that's okay if you're the kind of person who enjoys gambling. Maybe you go to Las Vegas for the weekend. But if you are speculating and you think you're investing, that's not okay. Because if you put the majority of your money in that kind of approach, sooner or later you're going to be wiped out. So one really basic principle is to segregate your play money or your mad money from your serious money. Another really important principle in the book is the very basic idea that stocks are businesses. They're not pieces of paper as they were in Graham's day, or electronic blips on our phone as they seem to be today. That's not a stock. That's the representation of a stock. A stock is an ownership interest in an actual underlying business. And if you don't know what the business is, and you don't understand how it generates cash, and why it's a good business today, and will be a better business in the future, then you have no business investing in it. You don't understand it, and you're not investing, you're just speculating. One other vital principle from Graham is the metaphor of Mr. Market. Right. He asks us to imagine that we own a small business. Maybe it's a video game production company. Maybe you run a small accounting firm or a law firm, or a dentist. You're a dentist or a doctor, and you have a neighbor, and Graham calls him Mr. Market. And every day he knocks on your front door and he says, "How would you like to sell me your business?" And some days he offers you way more than you know the business is worth. And maybe he offers you so much that you'd actually consider selling it to him. Other days, he's in a lousy mood and he offers you way less than the business is worth. And Graham wants us to think, would we trade with this man? Would we sell our business to him merely because he's asking us to? Nobody would do that with a business they owned. But people do it with stocks all the time. The market crashes and people sell to Mr. Market at the very moment when the prices he's offering make no sense. And that's what Graham wants to cure us of. Listening to you,
it sounds as if an individual is at the whims of Mr. Market, and the intelligent investor is not, is somehow shields himself from the whims of Mr. Market. Easier said than done, right?
Yes, it is. It's probably harder today than it's ever been because we all have those computers in our pockets. You know, we're walking around with a cell phone, and you may well have your brokerage account on your phone. If you aren't careful, it will be sending you trade alerts multiple times every single day. It may be urging you to trade in the middle of the night. And some people can get up in the middle of the night and trade. And it's very easy to become addicted to that. But Graham wants us to think about something even more interesting, Consuelo, which is, he says that individual investors don't have to be the patsy in this. You know, it's very common for people to believe that institutional investors like hedge funds and giant insurance companies and mutual fund companies dominate the market, and it's impossible to compete with them.
The smart money, so-called.
The so-called smart money.
Right.
But you can't compete with them if you play their game. But what Graham wants us to realize is, first of all, they can't play their game. They lose at their game. Most professional investors underperform their own market benchmark year in and year out. So why would I want to compete? Why would I play on that playing field when the teams on that playing field are losers? What Graham wants us to do is play on a playing field where we can win.
And he calls that an individual investor's basic advantage, right?
The basic advantage is that we don't have to be judged by the same standards as professional investors. A professional investor has to try to beat the market every year, every quarter, every month, every week, every day, every hour, every minute. And some people are judged by the second. And Graham's point is, as an individual investor, you should judge yourself by the progress you're making toward your long-term financial goals, not by whether at a given moment you're outperforming the S&P 500. And when you try to compete with the pros at their own game, you lose before you even go on the playing field. And his point is, don't go on the field. Invest, but don't invest with their horizons and don't invest with their practices. Use your own judgment and follow your own rules and guidance, and that's the way you succeed.
What are the rules that individual investors should follow?
You want to stop investing on whims and hunches unless you're doing that for fun. And in the book, I talk about how there's two forms of investing. There's investing as enterprise, and there's investing as entertainment. And if you're investing for entertainment and you're using a small amount of your money for it, that's fine. But if that's driving all your decisions, you need to rethink what you're doing. So you want to structure all your decision making. So you should have a rule. I will buy no stock or fund without filling out a checklist. And there's many examples in the book of what you might include in a good checklist. But it's the basics. Have I read the annual report? Have I looked at the proxy statement to see if the managers are fairly compensated? Have I tested the products? Have I thought about why this is a good business and why it'll be a better business down the road? You also should have a watch list in which you put the companies you're interested in if, but only if, they go down in price. And that keeps you from chasing stocks that are getting ever more expensive. And you also should have procedures in place that will help you automatically rebalance the amount of money you have allocated across different assets. Good long-term investors will also dollar cost average, putting a fixed amount of money into the market every month or every week or every quarter. And by structuring your decision-making that way, you take your impulse out of the equation and you become much more evidence-driven, which is what you want to be as a long-term investor.
Jason, there's another core principle as well of Benjamin Graham's in The Intelligent Investor, and that is the margin of safety. So talk to us about why that concept is so important.
Well, it's a principle that Graham adapted from engineering. If a bridge is designed to hold a 5-ton truck, the engineers make sure it can withstand 10 tons of weight. Because you don't want to drive a 5-ton truck across a bridge that can only hold 5 tons. It's just a really bad idea. And likewise, passenger jets in the United States, and I believe pretty much everywhere around the world, are designed so that if one engine fails, they can keep flying safely. And they do. And you simply want to apply the same principle in your investing. If you think a stock is worth $100 a share, then you certainly don't want to pay $200 a share for it. You don't even want to pay $120, and ideally you don't want to pay $100. You want a margin of safety. You want to pay $80 or $60 whenever you can. There's another element that is available to contemporary investors that wasn't really available in Graham's day, which is that diversification is itself a form of the margin of safety. By buying the entire market through a stock market index fund, you provide yourself somewhat of a margin of safety. It gives you exposure to economic growth as a whole across the entire economy, so that if you want to pick some individual stocks, you know you won't be totally left behind if the market takes off. And if your stock picks turn out to fare poorly, you won't lose all your money because most of it is invested in the market as a whole.
Who is the intelligent investor appropriate for now? Is it really appropriate for someone who wants to be an investor, wants to pick their own stocks, or is it also appropriate for what most individual investors are doing now, which is they're buying index funds?
I think the answer is both, Consuelo. Graham draws this really important distinction in the book between what he calls defensive investors and enterprising investors. And it has nothing to do with your tolerance for risk. It's not that a defensive investor is a person who should be all in cash or never take any risk, and an enterprising investor, is throwing all their money at some growth stock like Nvidia. That's not what he means. By defensive, he means you're someone who isn't prepared to commit the time and effort that's necessary to pick individual securities. An enterprising investor enjoys that. If you're the kind of person who might spend part of your weekend, reading the stock tables in the Wall Street Journal or plowing through a spreadsheet looking at various financial measures, you're an enterprising investor, and that book is for you. But if you're a defensive investor, the book is still for you because it gives you the principles that you need and the emotional framework you have to rely on to keep yourself out of trouble, to make sure that as a defensive investor, you don't fool yourself into thinking you're enterprising and end up making gambles that you'll regret later. And it teaches you those policies and procedures that will keep you out of trouble.
We always ask every guest on Wealth Track for a one investment for a long-term diversified portfolio. It can be an actual investment, or it also can be an investment of time that we can take.
Right.
So what would your one investment be?
What I'd recommend, Consuelo, is putting in place one of the structures that Graham suggests in the book. And I like to call it a mad money account. What Graham suggests is that you take a small amount of your portfolio and set it aside, and he makes a couple of really interesting and very powerful recommendations. First, you must never add money to this account. So let's say you set aside 5% of your money. If you blow through it because all the 5% of your money that you invested turned out to go to zero, you're done. You can't add more money to it. It has to be an ironclad rule. If you turn out to be good at it, then the account will be self-funding because the profits you make from your good investments will keep refunding it so that you can keep going. The other really vital point that he makes is that you can't commingle that money with your other assets. You have to take your mad money and you have to put it somewhere else so that you don't mix the two kinds of money, your long-term money and your mad money. And then, of course, you don't have to be mad with it. You don't have to do crazy things. You can do sensible things too, but you have to do them in moderation, and you have that cap, 5% or 10%, whatever you determine in advance. But I think that's the single best way that people can keep themselves out of speculative trouble when all about them are losing their heads, as Kipling said long ago.
Jason Zweig, the intelligent investor sounds extremely disciplined to me. There's a lot more to talk about in Benjamin Graham's wonderful classic that you edited, and it's being published for its 75th anniversary. So I look forward to continuing this conversation in our next episode. Thank you, Jason, for joining us today.
Thanks, Consuelo. Great to be with you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is for those of you who want to become better and ultimately successful investors. It is read the new edition of The Intelligent Investor by Benjamin Graham. It is an investment classic for a reason. When adopted, his principles, process, and mindset work Just ask Warren Buffett and other great value investors who follow his teachings. Benjamin Graham was both an extremely successful investor and, by all accounts, an inspiring teacher and mentor as well. He was also a clear and lucid writer. In this new 75th anniversary edition, you also have the benefit of about 200 pages worth of commentary and tutorials on each chapter by Jason Zweig, one of the preeminent personal finance journalists of our time, and a Ben Graham scholar and believer. The Intelligent Investor is a cherished cornerstone of Warren Buffett's library. Maybe it should be for yours as well. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.